Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from the Federal Home Loan Bank of Topeka, which sounds about as exciting as watching paint dry. But stick with me because hidden in this financial paperwork are clues to how banks are lending money and the risks they are taking. It's like being a financial detective. We're looking at what's called a Form 8K. Companies file these when big things happen that investors need to know about right away. In this case, it's about the bank creating what's called a direct financial obligation. Sounds complicated, but it's really just about the bank borrowing money. The Federal Home Loan Bank of Topeka, or FHL Bank, gets most of its money by selling debt. Think of it like this. The bank issues IOUs, called consolidated obligations, to investors. These obligations, which are bonds and discount notes, are the shared responsibility of all 11 Federal Home Loan Banks. If one bank can't pay, the others have to chip in. It's like a financial safety net. These banks are watched over by the Federal Housing Finance Agency, or Finance Agency. They make sure the banks play by the rules. The Finance Agency can even make one bank pay the debts of another. These consolidated obligations aren't backed by the government, so they rely on the financial strength of the banks themselves. Schedule A shows all the bonds and shorter-term debt called discount notes that the Federal Home Loan Banks have promised to issue. FHL Bank is the main borrower. And important to remember, the FHL Bank can change how they report this information at any time. Keep in mind that just because the bank is issuing debt doesn't mean it's in trouble. It could just be part of how they manage their money. Although issuing debt is a big part of what FHL Bank does, they don't say that any single debt is super important all by itself. The report doesn't get into interest rate swaps, which are ways the bank might try to protect itself from interest rate changes. You can't use this report to see how much total debt FHL Bank has because it leaves out some of the short-term debt. To get the full picture, you have to look at their regular reports filed with the Securities and Exchange Commission. The dollar amounts in this report are just the face value of the debt. They don't include any discounts or extra charges. Now, let's jump into the important details. Schedule A, which is the schedule detailing the issued consolidated obligations. On March 25, 2025, they committed to issuing a bond. The exact details are important. The bond has a CUSAP number, which is like a serial number for securities, is 3030B5QA9. The bond was issued on April 21, 2025. It will mature on April 8, 2030, which means that's when the bank has to pay back the full amount. The bond holders will get their first interest payment on October 8, 2025. The bank has the option to pay off the bond early. It's a Bermudan style, meaning it can be called back on certain dates. The interest rate is fixed, meaning it stays the same. The first date the bank can call the bond back is May 8, 2025. The interest rate is 5.15%. The total amount of the bond is $15 million. Let's define the terms in the table for context. For example, optional principal redemption bonds means the bank can choose to pay them back early. There are also different call styles like American bonds, which can be paid back at any time after a certain date. Fixed bonds have interest rates that stay the same. Variable bonds can have interest rates that change over time. And constant bonds are a type of fixed bond with a steady interest rate. Finally, the report is signed by Brad Gentry, who is in charge of funding and hedging at the bank. Now, what does this all mean? The FHL Bank is borrowing money, and this report tells us the basic details of that borrowing. The bank is betting that it can make more money using this $15 million than it cost them to pay the 5.15% interest rate. If interest rates go down, the bank might call the bond back and borrow money at a lower rate. This is a pretty standard type of transaction for a bank. Risks include interest rate fluctuations, where the cost of borrowing could increase beyond projected profits. There is also the risk that the underlying loans which this bond is issued against could go bad or suffer high default rates. The bank must balance these risks, but based on its actions, it seems comfortable that the overall strategy is a net positive. The bank's overall direction seems stable. They are borrowing money at a reasonable rate and managing their risks. The biggest risk might be changes in the overall economy, which could affect their ability to repay the debt or the profitability of their lending. It's a fairly straightforward financial move for the bank. Thanks for watching. If you found this dive into bank debt interesting, please like, comment and subscribe for more corporate decoder videos.